You're doing everything right. High income, saving hard, decent pension, big pile of cash. Meet Alex. 38 years old, 320K household income. On paper, Alex is winning, but Alex's portfolio is quietly stuck in three traps: cash drag, tax drag, and fragmentation. Today, we're diagnosing it. And in the final episode of this three-part series, I'll show you the 20-year math of fixing it. Let's build a composite person. I've seen thousands of portfolios just like this. People in tech, medicine, consulting, finance. Household income in the UK is somewhere between 150 and 400K. They're not reckless and they're surely not trading meme stocks. They have somewhere between 150 and 300K sitting in cash. Savings accounts, current accounts. I have been there for a long time too. You might even have a workplace pension invested in whatever the default fund was when you first signed up. If you have a couple of good friends who have influenced you, you'll have a stocks and share ISA with a few ETFs. Maybe even a global tracker, a dividend fund that someone mentioned to you a long time ago. You could even have employer shares building up, and you almost certainly have an old pension from a previous job. From the outside, everything looks sorted, but internally, there's usually a quiet uncertainty because they don't actually know for sure if this portfolio is good or if it's just not obviously bad. Today, we're going to run a diagnosis on this exact portfolio. The first trap is the cash drag. It's one that I also got stuck in for a long time because cash feels like control, especially when your income is high and the number in your savings account keeps growing. It feels responsible to have a buffer. Of course, we're told to have an emergency fund. But what we forget is that the cash you keep in those accounts often have a hidden price. Let's say you have 200,000 in a cash account, earning around, if you're lucky, 4% in the UK. That gives you about £8,000 of interest every year. Sounds fine. If you're a higher rate taxpayer, that actually becomes closer to 4,800 after tax. Once you adjust for inflation, you're probably not making much at all. Now compare that with investing in the long term in a well-diversified portfolio. The real issue isn't the interest rate that you're being offered. It's the fact that money is sitting in the wrong bucket. Bucket one, the emergency fund, 6 months of essential spending in cash, non-negotiable. Bucket two, near-term goals within the next 5 years. Keep that in cash or very low risk. Bucket three, long-term wealth. 10-year time horizon, and that money should ideally be invested. Every pound sitting here in cash is paying drag tax. Here's the diagnosis question. Can you give every large pile of cash a specific job and a specific timeline that you have access to right now? If not, you don't just have safety, you have drift. Here's a quick test to help you discern. If your income stopped tomorrow, how many months could you live without touching your investments? 3, 6, 12? Whatever number just popped into your head, that's your real emergency fund. Everything above that needs to be assigned a job. In the next episode, I'll show you the simplest way to turn cash drift into a repeatable investment system so every pound or dollar has a role to play. The second trap is sneakier because you don't feel it. It shows up quietly year after year as a smaller after-tax result. In the UK, we have some of the best tax wrappers in the world, and most high earners barely optimize them. There are two concepts that matter: asset allocation and asset location. Asset allocation is what you own: stocks, bonds, gold, cash. Asset location is where you hold them: ISA, SIP, general investment account, and most investors focus entirely on allocation. But the location is actually where a lot of hidden leakage happens in portfolios. A tax-free savings account means you pay no capital gains tax, no dividends tax, and no income tax. And this is where you want your assets to be for long-term growth. The SIP gives you tax relief upfront, but income tax when you come to the point of withdrawing it. Your general investment account is fully taxable. So ideally, the most tax efficient investments should sit in this account. The classic mistake is when people do it the opposite way. That tax logic is backwards. The diagnosis question is, are you receiving taxable dividends in your general investment account that should be sitting in your tax-free account? Even if you have the best asset allocation, do you actually know where each asset lives and in which specific account? If the answer is no, then you have tax drag. In the next episode, I'll show you a simple rule for assigning each asset to the right investment wrapper. The third trap is the high earner special. And that, my friend, is fragmentation. Your portfolio didn't get messy because you planned it that way, but it evolved through life. You have an old pension from your first job, a current workplace pension. You maybe opened an ISA during COVID when everybody was talking about it. And somewhere along the line, you ended up with a general investment account that has a few ETFs in it, maybe even a few individual stocks if you felt exciting at the pub. Individually, none of these is terrible, but collectively, you can't answer one basic question. What is my total allocation? When investors can't see the whole picture, three things happen. First, they accidentally concentrate their allocation. Most higher earners are massively overweight to US large cap tech, often without even realizing. Secondly, fragmentation prevents optimizing your taxes, simply because if you don't know your full portfolio, you can't place assets within the right wrappers. Thirdly, you end up making emotional decisions because when everything feels a little bit vague, every market drops creates the feeling that you should do something. The fix is to have a structure that is simple enough to see your entire portfolio in one view and to have it broken down into clear pillars or buckets with explicit jobs for each. Fragmentation doesn't just feel messy to high earners. It actually changes the maths because small inefficiencies can compound over the long term into a very large gap that opens up in portfolios over 20 years. I'll show you the exact numbers of this in episode 3. If you're a high earner and your portfolio still feels a bit uncertain, it's usually not because you're bad with money, but it's because these 3 quiet drags are working against you. But here's the 60-second audit. Pause the video and answer this. How many months of essential spending are sitting in your cash account? Does everything above that have a clear job? Do you know why each asset lives in the account where it currently sits, or did it just end up there over time? And can you describe the total allocation of your investments in one sentence? If any of those are a no, you're in one of these traps. It's not all doom and gloom. Here's the good news. The solution isn't that you have to become a financial nerd. It's also not that you have to check markets daily. The fix is that you need a structure that is built around clear pillars. In the next episode, I will show you the framework that I had to employ to get myself out of these 3 traps, how to assign a job to every dollar or pound, simplify scattered holdings into a clean structure, and rebalance without relying on willpower. In episode 3, we will run the numbers. And the 20-year gap between staying in one of these traps and fixing them That gap is usually the moment when people realize something actually needs to change in their finances. Episode 1 is the diagnosis, episode 2 is the treatment plan.